A cryptocurrency tycoon lost $1 billion in a single day. How was it possible? Why did FTX, one of the largest cryptocurrency platforms, valued at $32 billion, fail? The answer is not simple, but it is clear. Fraudulent management and a total lack of transparency were what ended the dream of Sam Bankman-Fried and his crypto empire. FTX seemed like the future of the cryptocurrency market. It had a huge user base, a popular crypto asset exchange platform, and a valuation that was skyrocketing. Everything indicated that FTX was going to establish itself as one of the most important players in the sector. But the stability that the platform boasted so much had hidden cracks. A collapse of this magnitude doesn't happen overnight. What happened at FTX was a mix of poor financial decisions, lack of control, and irresponsible handling of users' funds. Before continuing, remember to leave me your like and subscribe to continue seeing more content like this. FTX grew at breakneck speed, but it did so on a structure that was never solid enough to support such growth. As their assets and user numbers increased, so did the risks. The lack of internal oversight and the absence of clear rules on how clients' money should be handled were the triggers for the debacle. Instead of ensuring the safety of funds, FTX began using investors' money for risky trades. By doing so, it not only endangered the future of the platform, it also shattered the trust of thousands who believed in it. 2022 was the year everything started to fall apart. In a twist no one had anticipated, FTX stopped being the star of the crypto market. It became the epicenter of one of the biggest financial scandals in recent history. It all started with an article revealing that clients' funds were being used in high-risk investments without their consent. That was the first sign FTX was hiding something about its handling of funds. The alarm went off, and users began to withdraw their money all at once. Panic broke out. As funds vanished and rumors of the platform's insolvency grew, the situation became untenable. Investors who had once trusted FTX as a safe haven suddenly faced a harsh reality. The platform, instead of protecting their money, had wasted it on risky bets. And worst of all, there was no way to recover the funds. FTX was bankrupt. What exactly went wrong at FTX? The answer lies in the lack of transparency and the poor management of user funds. The platform never offered a clear explanation of how it handled investors' money. Instead of an open and accessible audit, they chose opacity. Users trusted a company that presented an impeccable facade, but in reality, operated under an unstable financial structure. Client funds were not only mismanaged, they were used to finance other high-risk projects. It was as if everything was part of a giant financial game of chance. The FTX crash also exposed a flaw in crypto market regulation. For years, regulators looked the other way as these platforms grew unchecked. FTX was one of the first giants in the sector to be brought down. But it wasn't the last. The lack of clear rules and proper oversight allowed companies like FTX to operate irresponsibly. Now, the crypto industry faces the challenge of proving it can be a safe and reliable space for investors. Despite the enormous risks, cryptocurrencies remain an attractive market. However, the FTX collapse should serve as a lesson. Cryptocurrencies can offer great growth opportunities, but investors need to be much more careful when choosing where to trust their assets. What happened with FTX was the result of irresponsible management, not an inherently flawed market. While cryptocurrencies have enormous potential, investors need to be much more careful when choosing which platforms they trust with their assets. What happened at FTX is a reminder that even in a market as innovative as crypto, transparency and accountability are essential. Users must demand clarity on how their funds are managed. Companies, for their part, must operate with the highest ethical standards. Without these foundations, the collapse of platforms like FTX is not just possible, it's inevitable. The FTX collapse also underscores the importance of financial education. Many investors who fell for the FTX scam didn't fully understand the risks they were taking. It's crucial to understand how cryptocurrencies work, how the platforms operate, and what steps to take to protect your money. In a market without clear rules, the best defense is knowledge. As crypto continues to gain acceptance, investors need to educate themselves on both risks and opportunities. The fall of FTX has not only been a harsh blow to the crypto world, it's also a stark reminder of the risks in a market that, although innovative, is still evolving. It lacks the necessary regulations to protect investors. For many, FTX was a promise of a bright future, one of the most popular platforms for exchanging crypto. But when that promise was broken, it left a painful lesson about the lack of transparency and irresponsible management. It ruined the trust of thousands. Still, this collapse opens an opportunity to reflect and learn. Cryptocurrencies have enormous potential as an investment tool. But to harness that potential, the risks need to be approached with caution and understanding. What happened with FTX doesn't define the entire crypto market. It reflects a series of poor decisions inside a single platform. In fact, cryptocurrencies like Bitcoin and Ethereum continue to show long-term viability. But investors must be smarter, more informed, and more cautious. The FTX scandal highlights the need for regulation in this space. For years, the crypto market grew without clear oversight, allowing irresponsible players to act without consequences. While the market is still young, the time has come for governments and regulatory bodies to step up. They need to ensure platforms operate with transparency and ethics. The FTX case made it clear that without clear rules, financial disasters will keep happening. Some might see crypto as just a speculative bubble, but with the right regulations, it could revolutionize global finance. As for investors, the biggest lesson is that trust must be earned. Crypto platforms need to be transparent about how they handle user funds and make decisions. Investors, on their end, must understand the risks. They can't get swept up by promises of quick gains. Instead of chasing shortcuts, it's essential to analyze everything thoroughly before investing. The FTX collapse showed exactly what happens when these basics are ignored. On the other hand, FTX's fall has also pushed the industry toward necessary changes. Users are now more alert and demanding. They want transparency and greater responsibility from platforms. This pressure is forcing companies to adapt, improve internal controls, and ensure fund security. The crisis has also led new platforms to prioritize ethics and responsibility. They now see that transparency isn't just a legal obligation, it's also a competitive advantage. The future of crypto is far from sealed. Despite FTX's downfall, the space remains dynamic and full of potential. It's not about avoiding the market, but about evolving with it. The key lies in financial education. Knowing how to tell apart platforms committed to responsible management from those that only want to profit off public trust. Those willing to learn from past mistakes and demand real change will be able to navigate this world more safely. That's all for now. Let me know your thoughts in the comments. Also, don't forget to subscribe, share, leave your like, and activate the notification bell to have more content like this.